The counter view to your hypothesis is that in January, maybe fresh allocations open up. We start off a reasonably good earnings season because of the low base effect, and the combination of the two can actually see the market edging higher. How much of a probability would you assign to that?
Well, I think as you rightly mentioned, it's going to be of a low base. So is it going to be smart, informed investors who are going to buy stocks because, you're seeing high growth of a low base? Obviously not. It could be the retail guys. It could be less informed investors who might buy that. So even if the market were to rally and if one of the bases is what is because of numbers being higher on a low base, then that rally will not sustain. The second thing is, I've heard this I've heard this Jan story for so many years now, and I think if you look back in history and you see how many Januaries we've actually seen good strong FI numbers, I think the numbers will actually very strongly disappoint you. And I think I also want to juxtapose the fact that we've seen strong numbers in December. We've seen fairly strong inflows. 2009 has been one of the highest all-time FII inflows. More than $16-17 billion, and the market is still, not been able to actually cross 5,200. It's far away from its all-time high. So I think you want to put those in perspective, and I think the risk here, I would argue that the risk on the FI numbers is actually the opposite. The risk is actually that what if the FI flows don't come in? The earnings numbers may, on the other hand, on a low base, show a good growth, but I think that's not going to excite smart, informed investors.